Good morning, Chris.
Good morning. How are you?
I'm good. This is Brian. I'm here with Chris Hood, professional trader, world's most interesting man. Going to tell us a little bit about the markets today, right?
Um, and world's best haircut. I
Yeah,
am
I did
so,
notice. I did notice that you're looking pretty stylish there with your haircut.
as Ric Flair would say, styling and profiling, man. I'm telling you, this was the best experience I've had, was having a haircut after so long. I didn't know what it was like to have wind in my hair. And, obviously now with the sun, going out for a walk on Sunday, getting the sun on my ears, started to become attractive to birds, by the way.
Oh yeah, they
Birds started
come down. They're
to
just
sing.
attacking you.
What's that?
You just got to use another Ric Flair quote whenever the birds come after you. Go woo. Something like that. It's a great one.
I'm going to try and get a pair of snakeskin boots, see what
Yeah,
happens.
exactly. So I've got this lighting situation here. I'm not really sure, so I apologize to anybody that feels like I'm doing this of
From
YouTube
heaven.
thing from the heaven or a cave or whatever. But hopefully the content will make up for.
And I'm just hearing angels singing. I don't know if that's real. It's like there's a choir of angels sitting there going, "It's Brian." There we go.
I've just got the worst lighting setup. Anyway, so what's going on this week as far as the market? What do you see?
Man, it's been an interesting couple days because what we've seen is very rapid rotation, right? So we've seen Nasdaq go up, Nasdaq come down, banks go up. We're in earnings season again. It's like earnings season's like every week, man. It feels like it was last week that it was earnings, or a week before. So what you have to be aware of is this rotation of money going in. It's not the money going into these sectors that are going to have earnings announcements or potential upsides. I think earnings season this year is going to be, or now is going to be really good because they're comparing it against COVID. So year on year numbers are going to look fantastic. And I think Wall Street set the bar really low. So I don't think expectations are going to be, people are going to be making a lot of money up here. I think expectations are here. Guys are going to overshoot. I think earnings season is going to be good. So what we've seen is money coming out of these high growth stocks, tech, over the last 2-3 days, moving into the stocks that are going to be leading in terms of the earnings race, right? So finance comes first, the banks, etc. So a little bit of rotation. It's causing a little bit of retail traders to get a little nervous. What I've noticed is that the more people get involved in trading, the more skittish things become. People become like squirrels. And, we certainly start to see that where a lot of retail guys in the morning are getting flushed out. These early morning gap downs, early morning algo, sell programs that go into the market that hunt out these stops. It's pretty frequent. And it can be pretty brutal, particularly to guys that aren't watching their trades all day, right? They go in, they set them, everyone reads the same information. It's like, everyone's read the same book. Everyone knows to put their stop order at the lowest low of the day before, the previous day's low. So they do it, and then the market flushes down below that level, wipes these guys out, and rebounds. So these guys go out, go, gee whiz, I did really well. I only lost 20%. And, the algo guys have made off like bandits. And it can be pretty frustrating, particularly if you're a retail trader. So you've just got to trade. You got to trade safely. In these markets, you can de-risk your portfolio by either going really, really short term, so trading intraday, right? Or you can push your trades out really, really far and take away the impact of that volatility. So you've got this sort of choice between these two time frames. You've just got to be careful not picking the middle, because if you pick the middle, you can get sideswiped from both directions.
So what do you consider the long duration versus the middle trade?
90-day plus. So if you're going to be doing bull call spreads or whatever, what you would be looking at is a sort of 90-day trade, sort of the 60 delta, buy the 60, sell the 30 kind of situation on a 90-day trade. It doesn't mean you hold it to 90 days. All right. So just because we bought that time doesn't mean we do it. What we would do is plan to trade that really, really short term, but hold it longer if we have to, if the market moves against us, right? So whenever you're looking at markets where sort of indecision can hurt you, you've got to buy yourself time to be right, right? That's one of the most basic concepts, is just give yourself an opportunity to be right. I find in these markets, sometimes trading on really, really short time frames works better as well, as long as you're using your Keltner channels correctly. So understanding the swings and roundabouts of price, and understanding how stocks move from the mean to +3 and then back to the mean, maybe down to -3.
You're
If you're
talking about
doing,
just catching the move, say from
yeah,
the first, the second,
yeah, the sensible thing is, if you see a stock that's extended, right, it's trading outside of its Bollinger Bands, or it's trading above the third Keltner, don't buy it. Like, just be patient and wait. Okay, so those stocks can tend to trend there. They can trend above the third Keltner. Just because something's at the third Keltner doesn't mean it's coming back. It can trend there for a bit, but at some point, all right, so patience pays off. At some point, that price pulls back to the mean. Now remember, as the price is staying above the third Keltner, the mean is rising. The 20-day moving average or the 21-day moving average starts to rise. So a pullback is not going to drop down 3 ATR. A pullback might just be 1 ATR pullback to the mean. So a lot of people's expectations around where price will go can sometimes be a little bit frustrating for them, because they're expecting a drop to the 34, for example. And I'll show you an example. Let me share my screen. So, one of the things that you'll look at is, let's say Google, for example. Google for me is a favorite trade, right? So for me, I like using Google because, A, there's a lot of institutional support in Google. I believe it's coming up here into this 2,600 level. But for Google, the 34 EMA, which is down here in this sort of pink area, this is the most ideal spot to be buying Google. If you're going to be going long Google, this is where you want to do it. It's unrealistic to expect Google to get down into this box, because you know what? It doesn't come here very often. So it did hang around here for a bit. Back last week, there was that pullback that we had. Didn't last very long. This is the 1-hour chart. So this was literally a day. If you weren't ready for it, if you weren't looking for it, or if you got scared because of a gap down, you missed that opportunity to go long in Google over here. We landed up doing a bull call debit spread and a bull put spread on this pullback, right? On the hourly chart, we traded that. We made some money yesterday, and we're looking to do some more, because what we see is Google making at least a play into this zone between 2,560 and 2,6. We can see it. I don't know when it's going to happen. I can't tell when it's going to happen, but I know that the trend is definitely towards there. We have a squeeze that's fired long. Our awesome oscillator is also telling us that we've got, momentum increasing. So, you've got to play a planned game. I think a lot of people tend to come to the market in the morning and go, all right, what's on the cards today? And that's not the way to play this game. What you've got to do is actually do it the night before. So the night before, you would be scanning through the market to see where closes were on particular trades and sectors that are strong. Build your short list. I've got a short list over here that I use. So one of the things that I use to determine where money is moving and what stocks are worth playing, or what sectors, is you start at the top, right? So you look at all your sectors. So you've got consumer staples, et cetera, and you rank them. So what I do is I look at all of these, looking at the EMAs, I look at the squeeze situation, I look at the relationship of the SMAs, and I look at this and say, well, if the 8 is above the 21, the 21 is above the 34, and the 34 is above the 55, so this is on the SMAs, this will give me a yes, 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 which then tells me I've got momentum, sentiment, and trend. My EMAs should be bullish as well. So these are the SMAs, these are the EMAs. And then what I look for is trading above the cloud on the Ichimoku. So if it's trading above the cloud, so here we have XLP, consumer staples, at 69.99, is trading just underneath the bullish line of the Ichimoku, so the span A line of the daily Ichimoku cloud. To me, that's not particularly bullish if the price is below that line. It needs to be above 70.54 for me to be very bullish. From an ATR perspective, the stock is still trading above its ATR, which tells me, yes, I can do the trade. So from here, I would be able to determine if I was going to do a trade in XLP at the sector level, I would probably only go with a 1/3 or a 2/3 trade just because of that Ichimoku line. Fine, do a 1/3 of your position, trade it up. When that signal improves, we can then go forward and do more. So you start from this level, right? So you go, am I going to trade the sector, or do I want to trade individual stocks? If we decide, you know what, we're going to do a trade in, let's see, XLK, right? So this is the technology one. We know that XLK is pretty much Apple, Microsoft, and Nvidia. Those are the three trades that make up 50% of this ETF. So you can either trade XLK as a unit, as itself, or you could trade any one of those stocks individually. So I trade Apple individually, Microsoft individually, Nvidia individually, and XLK as a group, right? So I do all three. Now, when we look at XLK, we can break this down further by going into XLK by itself and then taking the top 10 stocks of XLK and comparing them, right? So if I look Apple, I've got yes, 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 bullish, bullish, new 52-week high, reasonably good volume, MACD is positive, trading above the ATR. I've got the IV at below 50, so it's a long call or a call debit spread trade. So Apple would be a trade for me to do. Yesterday, we bought stock in Apple, and we've got Apple call options as well. So we quite leveraged in this position. If we look at Microsoft, similar situation, all bullish, hasn't hit a new 52-week high. So, you know, we've still got to trade in Microsoft because it's one of the strong ones. But this is how you do it. You literally just work through all the trades. AVGO, we did a trade yesterday afternoon on the back of 3 yeses and squeezes that are forming across 3 of the major time frames. All right, so because I've got these squeezes forming and I'm cheap, the IV is cheap, I'm looking for my call options to expand in price. We did a call debit spread here at this trade. We've got this trade looking just above the ATR and also above the Ichimoku cloud, the span A. So for me, that's a pretty, you know, it's a no-brainer kind of trade. But I wouldn't be selling credit spreads on this trade because the IV is just so low. The only one in XLK that has an attractive IV rating is Intel, but I don't have my bullish setup here on the SMAs. So if I'm going to be doing that, I need to understand the risk that comes with having the stock trading where the 8 is below the 21. So these kinds of setups, right, is you start at the top, look at the sector, then look at the individual trades and pick the strongest one. Pick the easy money. You can do this in graphs as well. I find it a little easier to look at it on a table, and you can do this for each sector, right? This is not, you know, this is not a methodology that's unique to me. There are hundreds and hundreds of traders out there that use the same process. You know, you could look at healthcare as another industry or sector that we like as well. Lots of yeses, you know, the triple yes, together with squeezes that have actually fired off, giving you lots of opportunities at the moment. So, you know, I think that you've just got to time yourself. You know, you've got to play a plan rather than play the market as it is. I don't play the market. I just play a plan, and my plan is derived from data. So if my data is telling me there's a trade, I go and do the trade. I don't see, there's nothing, you know, we're not putting rockets on Mars here. You know, this is pretty logical stuff. It's just many basic traders or many beginners don't have a process by which they start at the top and work their way down. They sort of move around in a zigzag kind of pattern, and then they come to a deduction onto whether they're going to do the trade or not. And it's usually based on emotion. You know, it's usually an emotive response to things rather than a database, you know, decision process. So they look at it and go, oh, the market gapped down 5%. I'm not going to do anything. If the market gaps down, that's the time you're supposed to go in and do your shopping. You know, you're not going to get, you know, why would you be wanting to buy Google up here at the 3rd ATR when if you were patient, you could have bought it down here at -2? You know, that's a far more attractive proposition. You know, there's a common saying, the only people who don't like discounts in the world are traders. You know, like well, let's put it this way, retail traders. Retail traders have a way of thinking that this is good value and this is not. So, you know, you want to be on the right side of the trade. So don't get into a trade up here. Get into it. Just be patient. Yeah. If you'd waited 1, 2, hours, 1 hour, 2, 3, 4, 5, 6, 7, 8 hours, you would have got your pullback. Now, the problem was on Thursday last week when we got this pullback, many people misinterpreted this pullback and said, well, is there more to come? Right? Is this going to be bad? Because if you look at the day chart on Google, the pullback was not big at all. So if we go back to Thursday, Thursday was the 11th. If we look at this pullback, look what happened. It only pulled back from +3 down to just above the 8 EMA to +1. Usually pullbacks come down to the mean. So the interpretation of this, and you can see this box that we had built. So for my subscribers, we had actually said, if Google falls into this box, which would have been a phenomenal buy, and we literally missed it by, 40 cents, 50 cents. If Google had fallen in there, we had quite a lot of orders to sort of fill up the boots, because it was unrealistic to expect Google to fall all the way down here based on how much volume had actually been going through the trades and how much had been traded before. These big stocks don't just fall out of bed, so.
What is the, what do you have set for the box? What is the
effectively what I used was just previous low.
Mm-hmm.
And I've looked at the ATR. So if you look at the +1 ATR down to -1 ATR. So +1 ATR to -1 ATR to me is my buy zone. If I'm in there and there's price chopping around that, I don't really pay much attention to price in the box. I don't really, any movement that happens in price between -1 and +1 is a little noisy. It's not really, something I'm going to put a lot of attention on. I will look at going long in a strongly trending stock, trending in the right direction, anytime between +1 and -1. That's part of my rules. So if it got into the box, it didn't get into the box. This is the problem. It didn't get in to the price point that I wanted in order to achieve the goal. So the goal for me was it was going to pull back into the box, bounce off the 8 moving average, or bounce off the 34 into this circle. This is where I think Google is going to be over the next week to 2 weeks, because earnings is coming up, right? We've got earnings coming over there. I think that this area here, this whole area from 26 to 27 goes into play, right? So if you think Google is going to get to between 26 and 27, buy yourself a long dated call butterfly and play the direction, right? You can do that. Problem is, it's an expensive stock. So it becomes quite expensive to trade it. So you've got to trade your plan. The plan here is, Google, this is not a stock that's falling, right? In any instance, if you looked at this graph, you would see this stock is rising, bottom left, top right. It's moving in the right direction. This is not a stock to short. I have certain stocks on my list which I just do not play to the short side, because you'll get wiped out. Imagine if you played Google on that drop to the short side. You wiped out already. The position's dead. You don't play strongly trending stocks to the short side. There's just no reason to short this. It's the same thing at the market level. Market's trending, man. You trade the trend. You don't play counter trade. If you play counter trend, you're vulnerable to losing your head. So,
do you know any counter trend traders that just like to do that and do well at it at all?
You know what? The richest traders I've met are people who trade to the short side, because they make more money than most people when the markets go down. The problem is they have to have a lot of liquidity to survive the times when the market moves against them. So if you want to trade to the short side, you either have to have cojones made of titanium. I think you've got to have big balls. But you've got to, short selling and short trading, I enjoy it. When the market gives me the right setup and I can play it to the short side, I've been a lot more successful to the short side than I have been to the long side. It's just there's a story. The market moves up the staircase to the top and it comes down in an elevator. So you're going to be a lot quicker on the downside, but you've got to be fast. You can't trade short-term downside when the trend is to the upside. That's crazy. So yeah, I know a couple of guys that trade successfully to the short side. They tend to be neutral. So they have a portion of their book going long, a portion of their book going short. I find it sometimes really hard to have both on my book at the same time. I have to choose one side or the other. And when your market is, green EMAs, green SMAs, momentum is green, everything is green, 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 green. You don't short that. Like, there's nothing bearish about a rising market. Like that's another adage that's important to remember. Just because the market hits new highs, a lot of retail people say this, oh, the market's too high, we need to short it. Really? Like, that's just crazy. When I hear people doing that, or when my clients call me and say, should we short Tesla? I'm like, come on, on what basis are you doing it? They go, oh, but it's going down. I said, but the easy money's already been made. You should have been shorting Tesla when it was 900 back in January when we had that video. That was the time to be shorting Tesla, not when it's already made the move to the downside. A lot of guys get caught on the downside. They catch falling knives. And the reason is they have opinions. The one thing trading has taught me is don't have an opinion. You cannot have an opinion in this game. You either rely on data and you trade a plan, or you trade your opinion and you lose. That's just the way it is. The one thing that I've noticed is a lot of traders who trade, oh, I've got to sneeze. Man, this ragweed stuff here in Canada.
Do you have allergies, I guess?
Oh, excuse me. Oh.
Bless you.
Oh, I'm not the most elegant sneezer, so I apologize for that. And luckily, I kept it in, but usually I scream so loud that the neighbors will call 911. So you've got to remove yourself from opinions that can be dangerous to your account. If you're not aware of what they are, just monitor your trading and how you trade over a period, and you'll see things like, I think the market is going to do this. I think this. I think that. No, stop that. Like, as soon as any of my clients say, I think, stop. If you're thinking something, you're trading to be right. You can't trade to be right. You have to trade to be profitable. And sometimes trades will be counterintuitive. All right. Sometimes the data will be counterintuitive. So you've got to be careful about that. You've got to be careful about letting opinion come into your things. Like sometimes when you see these guys that have made lucky money on, these meme stocks, suddenly providing opinion on Wall Street bets or whatever it is, and, people losing based on that. I'm like, man, one trade does not make you a trader. Like, you cannot make a career out of one win. Trading is about consistency over time. It's about thousands and thousands and thousands of trades. How did you do over time? Did you make money or did you not make money? And that's the difference between good traders and bad traders, is the consistency and time. So yeah.
So I noticed you mentioned something about gold stocks taking a hit. Like, what do you see in the
So I'll show you gold, right? So gold, for me, I've always been a fan of gold, and I think gold for now has lost a little bit of its luster. Let me open up my gold stocks. So these are the gold stocks and silver stocks that I trade. And, I'd been in these stocks for over a year, and basically they had underperformed. They were at zero, right? They hadn't delivered anything this year. They made me money last year, but not this year. But if you look at this, I've got pretty much no signals to trade. I've got no yes trades here, right? So sure, I could look to hold on to these things and hope it gets better. Hopium, bad addiction, don't have it in trading. Or what you do is, I looked at this and I went, okay, we've got these squeezes firing short. I've got squeezes all over the place. I've got no trades that I'm available. It's all bearish. All these stocks are trading underneath these high resistance levels. So it makes no sense trying to be counter trend. Why would I sit in these trades, even if they're losing me money, for a hope of a rebound? I'm not going to do that. I'm going to wait for the signals to become green. All right, I'm going to wait for positive MACDs. I'm going to wait for green squeezes to form that they're, firing on the lower time frames. I'm going to look for yes trades here on the moving averages. And then I'm going to go, okay, well, which ones are yes trades? And then I'm going to move my money back. If you compare this setup, so bearish, red, 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 all of this red, compare this to my biotech stocks that I buy. Yes trades, yes trades, yes trades, yes trades. I mean, if you look at Moderna, we've been trading Moderna now since last year. Our Moderna trade is up close to 200% since we went in. This is a trade worth doing. And we do bull put spreads on Moderna on every pullback, right? So we sold one here, it's now up. We sold one here, it went up, we made money. Celdex is another one. Celdex is now up close to 200% since we got into the trade. So, when you look at the trends, this is a stock that's trending from the bottom left to the top right. It's got some volatility in it. Great stock for put spreads. Why would I put my money in a gold stock that's going nowhere when I can put it in a biotech stock that's going somewhere? So, I just moved a bit of my money out of the gold. I didn't put it into biotech because the biotech allocation in my account is already big. So I didn't want to put more in there. What I did was I bought Apple, I bought Nvidia, I bought some SPY, I bought some S&P 500. I was like, let me just take that money and put it into the things that are strongly trending, because I could easily just go and close Apple, Nvidia, SPY, and move it back into my gold stocks when those gold stock signals improve. I'm not emotional about it. I really, I like the idea of having those gold stocks, but
you're just rotating your money around, just like
I just put it into where I'm going to get the best return, and then when those signals start to weaken, I'll move it somewhere else, and then I'll go back there. And so this is why the analysis by sector is really important, because where do you really want to be? I mean, let's just add GDX here as well as the gold miners. All right, it's not a proper reflection of the stocks that I trade within the gold sector, but let's just add GDX for a second. Let's add biotech as well for a second. So where would you trade? Where would you really want your money to be trading? You want it to be in technology, you want it to be in healthcare, you want it to be in real estate, you want it to be in the S&P, and you want it to be in NASDAQ. Those are the only areas that have relative strength, and they have opportunities to trade it. So if you're looking at it going, well, I don't really want to be, trying to pick stocks, well, don't. Just pick the ETF. Pick these ETFs that have got relative strength against everything else. Go in, but, stagger your way in. XLK is already extended. So if we look at XLK, we can see that it's trading, fairly close to this third ATR. So it's not the most attractive entry. However, what you should be doing is saying, well, if that's the 8, that's the 21, that's the 34, what I'm going to do is put a little, I'm going to put an alert here if it goes at or below that level of the 34 EMA, and I'm going to say, buy the trade. I'm just going to put in an alert that says, if this does pull back, I'm just going to show my alert. If I'm going to do this trade, I'm going to wait for it to get to this level. I've got some other price levels that I'm looking at as well. So, if it does pull back at any point, I have levels at which I will be very interested to add to my XLK position. This is a strongly trending stock in an area of the market that's got relative outperformance. I cannot be expecting the stock to pull back all the way down to -1 ATR. That would be unrealistic. However, if it does, I will buy. If it pulls back here, I will buy. This is about trading a plan. You can't just look at it and go, oh well, I'll see what the market delivers tomorrow. That's a really inefficient way of trading. What you should be doing is looking at what are the areas that have got strength, which are the areas that have got opportunities for me to trade the trend, buy a trade, put the trend in, get into the trend. So XLK, you could be looking at doing something 90 days out from now at the money, a 90-day at the money call option. You could do a 60-30 bull call spread. Bull put spreads don't pay very well on these trades that are trending up because the put premium is quite low. So I'm not using put spreads here, but I'm using long calls and I'm using the shares. I'll buy the stock, and I'll buy long calls on this, because what I want to capture is this movement.
So
Does this look like it's going to fall today? No.
I mean, it's so a question. Even when the IV is low, is this? I mean, and it's not, the price is not there, like the premium's not there on the bull put spreads or the credit spread side.
Yeah.
I mean, is it worthwhile to make some of those plays just to get a consistent add to your?
The thing, I suppose for me, I prefer not to. If the premium is not there and the data is saying the best value trade is a long call or a bull call spread, then I'll do what the data is telling me. I think trading a bull put spread purely because in theory it gives you a credit and you can, you get paid up front, I think sometimes can be a bit misguided, because you have to find the opportunity that pays you the best in order for that to work. So it's a question of I'm not saying the strategy doesn't work. I'm just saying you've got to find the right stock. So if there are stocks available, I think, when I look at this, I go through this IV strategy, and what I'm looking for is the above 70 indicator. So for me, if I just go through each sector, you can see put spreads not available here in energy, despite the fact that it's a bearish sector. We've got most of the players are bearish. We haven't seen IV starting to spike to the point where selling it makes sense. If we look at, let's take financials, here may be something here on CME. I don't know. We'll have to see. It's not ideal. With the green indicator, it's bull call spreads and long calls, maybe call butterflies. With a red indicator or a gray indicator, we could probably do some credit spreads. If we look at, let's see, consumer staples, this one's getting there. Maybe there's something here around Walgreens. I'm not sure. But you have to take into account the sort of bearish nature of the setup. This is the problem with bull put spreads. Most people want to sell them when the signals are all very bullish. What you've got to do is you've really got to be selling it at the perfect time when signals are about to change, or when signals start to give you an improvement in, towards the upside. So here, because I've got no positively stacked SMAs, I've got negatively stacked EMAs. Just because this is high, I wouldn't sell it, because the easy money is to the downside. This might be an opportunity to sell a call credit spread rather than a bull put spread, right? So trade it to the direction that the easy money will be made. Don't trade it to the opposite. Don't trade counter trend. Always stick with the trend in mind first. So, the whole thing is have a plan, build your plan, sit down. Okay, so, if I look at what I'm looking at this morning, I've got a list here. Here's my focus list of trades. These are all my trades that I've got at the moment that I'm focusing on. You can see a lot of them are yes, double, triple yeses. I've got a couple trades that I'm building, particularly here in energy. I think that the energy trade will take a while to materialize. So I'm building that trade. I'm not trying to trade it for short-term gains. I'm going to build it for long-term gains. And down here, biotech, I like trading Labu. I find it a very interesting product to trade. So I've got a trade on there, but everything else is pretty much, an okay trade to do. Cisco, I've got a bit of a speculation going on in there because of the squeeze.
Question with Labu and SOXL. I mean, both of those are leveraged. I know you don't like to do the options as much on XOXL. You'd rather do shares. What about Labu?
Labus are very similar because of its triple leverage nature. I try not to do the call options on them because they tend to get wiped out on any form of big move down. I get killed on the option, right? Mm-hmm. So if you're buying long duration leaps on these trades, you can get hammered. A sustained 3 or 4 day period where the stock drops 10, 15, 20%. It can really cause damage on those trades. So what you do is you buy the stock, so you get away from theta erosion and volatility impact, just buy the shares and accumulate in downturns. And that's what we were doing on SOXL. We were looking at the semiconductor market when everything was falling out of bed. We weren't trading the option, we were buying the shares. And we just accumulated. And now I think we're up on SOXL, I think we're up around 12% on that trade. I mean, it's not a big trade in terms of capital. Let me open it up. Yeah, we're up 8%, right? So it's not a big trade in terms of capital, but we just accumulate the stock, on down days, because we know what SOXL is capable of when that sector kicks in and starts driving the market up. This is one of the leading sectors in the market. If tech is going to rally, semiconductors are the group that's going to do it. So what you want to be doing is buying down here, -3, -2, -1. This is when we were accumulating our SOXL shares. And now we just hold them. Now we're trending back in the right direction. I always look at this. If SOXL is at -3, I buy the stock. It's almost like it's written in stone. You just buy the stock, accumulate 10 shares, 20 shares, whatever it is. But you're buying it for that longer term rise in the price. So trade a plan. Don't not plan to trade. It's like really the best advice anyone can give you is build a plan, and trade it. Takes out the emotions, takes out the sort of randomness of things.
Right. Excellent advice as always, Chris. I know the bell's about to ring, so we'll get off here and we'll see you next week.
Good to see you, Brian. We'll see you next Tuesday.
Hey, you too. Take care.
Take care, man. Bye.